as well, which is looking a little wobbly as well, Sonia.
Okay, let's head into the market opening because that is just going to hit our screens now in a bit. There you have it. Good opening for the market, 30 points higher on the index. The mid-caps are up almost about 200 odd points as well. And let's take a look at the first tick on the mid-cap index, up 140 points. The Bank Nifty is the one that's really charging ahead this morning. So 160 points higher on the Bank Nifty. Good opening, decent opening for now. Let's see whether we can build on to those gains. The space that's looking the best this morning is autos. Hero, Tata Motors, Eicher Motors, all in the green right now. Followed by JSW Steel, which is up about 0.6%. And banks are making their presence felt. SBI, Axis Bank, all in the green as we speak. Nestle India and Power Grid are a couple of other stocks that are trending in the green right now. Now, on the downside, ITC, the street was definitely disappointed. There was sell-on rally over there. Sell-on news rather. So down about 1.5% on ITC. Maruti Suzuki is down about 0.7%. Asian Paints down about 0.5%, and SBI Life also trending in the red at the moment. The broader market is where all the action is at because there is a big degree of outperformance that we're seeing in the broader market and plenty of stocks, some earnings impact as well. TVS Motor, by the way, is up about 1.5%. So the street has definitely liked the fact that these are, record high margins. Margins have gone up for 7 straight quarters. So the bull case is emerging stronger at the moment. But otherwise, not a bad opening at all.
Well, that's right. So now you said the actions in the broader markets. Boy, it is. SJVN is up closer on 9% as we speak. Big move is what we're seeing on that one. Aarti Drugs is seeing some follow-through. So that's up closer around 4.5%. Volumes as well picking up on that one. So that stock's clearly doing well. On the flip side, you have Sharda Cropchem that's seeing some more selling actually. So that's down. The numbers were very, very poor. It was down 6% yesterday. Numbers came at around 2:30 p.m. odd. It's down another 5% today. SRF as well. The commentary was very weak. So that stock as well is down closer around 2.5%. Chennai Petro, very weak numbers. Stock is down 7.5%. You have MRPL as well that's following suit. That one as well taking a bit of a knock. On the index, the problem I think is ITC that was doing so well for the last few sessions. The news has come spot on. They were indicating that they're making a move on the hotels business. However, the manner is not great. And that's why this market doesn't like it too much. They would have preferred a mirror image, simple mirror image, 1:1, which hasn't happened. But there's a call later today. So let's see whether or not we can get some clarification on that front. But that one's under some pressure. And from that gain of around 40-50 points, we're down to around a 20 point.
Okay, well, 20 points on the Nifty, 19,690 is where we are at. To begin with, I mean, the market breadth seems to be pretty solid. SJVN is up another 9%, so this seems to be in pretty, for now seems to be in pretty strong hands. And it's coming up on volumes as well, so keep an eye on that one. That's the top traded volume stock. Look at that. I mean, I think there are some blocks, etc., which have perhaps gone through because volumes are through the roof as we start the day. There is Mazgaon Dock, so keep an eye out on this one. It's a slow start, but huge volumes, 2% on Mazgaon Dock. There is Utkarsh Small Finance Bank, which is up 3.6%. Stocks at about, 53. We've got Poonawalla FinCorp, reported numbers. Stock did not really react yesterday. It's up 3% this morning, 379 on Poonawalla. Garden Reach is up about 2.5%. Again, in that same, shipbuilding space. So 623 on Garden Reach Shipbuilders. There is Action Construction Equipment, which was up 10% yesterday. So there is follow through with about a 3% pop. Titagarh has been unstoppable. And that one is up another 3% this morning. So there is, a fair bit of activity in the broader space. SRF is down 1.6. So it has bounced a little bit from it's bounced about 30-35 rupees after starting lower. So it's actually a green candle. So let's look at this one and watch this one as well. Chennai Petro, I think we mentioned, down about 8%, 9%. MRPL is down about 4% as well. So standalone refiners are a little lower. But in the broader market, it is clearly more up than down. Yesterday by close, it was 1:1 in terms of NSE market breadth. So that's the overall picture right now.
I just want to make one mention. Tata Motors is at a fresh 52-week high this morning, and that's at 639. So that's a gain of 65% this year already. Of course, comes out with numbers later in the evening and expected to be a good showing from JLR. Not so much for the India business, but JLR, Jaguar Land Rover will be good. So going into its numbers, it's the positioning, is on the long side. So some disappointment
just
if it comes.
Talk about the other Tata Group stock, Tata Steel, that came out of these numbers. The numbers are as flat because the street believes the numbers are not sustainable, and they're asking about how much of the beat in the India business is one-off We'll know about it in the next 120 to 180 minutes.
Okay.
Right, okay, we'll pick up on this one as well a little later on the show. Well, 20 points on the Nifty is what we have. Andrew Holland is Chief Executive Officer at Vedanta Alternate Strategies. He's with us. Andrew, good to have you with us here. Is the market starting to consolidate a little bit? Will we go into a slightly more sideways price action after what has been a very spectacular, fast-paced first half this year?
Yeah, no, it's been a good, enjoyable kind of ride over the last few months, hasn't it? But I think the markets were looking overbought, and it doesn't take, it takes a little bit of one or two kind of not poor results, but results in line, or some negativity around certain sectors, and it just takes the froth away from the market. So I'm okay with markets kind of drifting for a while now, until we get the next catalyst. The next catalyst is really going to be the kind of earnings upgrades, which we're going to start to see from the second half of this fiscal going into 2024. So that's the key for the markets to move higher. So we've had a great run. Everything's worked in our favor. No one likes China. Maybe that will change if there's a big stimulus package in China and take some of those flows away from India in the very short term. But otherwise, nothing to worry me at all, Prashant, at the moment. But I just think we got to a very overbought territory.
Okay. Nothing to worry, but where do you find alpha, right? That's the tricky part, Andrew. What do you do with some of these auto names? We were just talking about Tata Motors at a fresh high. Numbers are expected to be strong. Do you think a lot of the news is already in the price now?
I think, again, certain sectors will have the kind of run up, and I think the autos has had that. I'd probably be more looking at the auto components over the next 2 to 3 months is where you're probably going to get better share price returns, because I think as everyone keeps talking about electric vehicles, whether it's two-wheeler, four-wheeler, it's going to be the auto component companies which will do well. So auto components would be where I would be placing my bets. I mean, don't get me wrong, I wouldn't be out of the auto sector, but you've got to be very selective in which ones you want to back. In each, whether it's two-wheelers or four-wheelers, there's a great competition going on now in terms of the high-end bikes. Who's going to be the winner? We'll see. But, that's just going to increase competition and hurt margins in the short term.
Hi, Andrew. Good morning. Andrew, what do you make of the big ITC announcement? The stock has been a big outperformer in the last 18 months to 2 years. Before that, it was a big underperformer, waiting by for some kind of announcement on the hotels business. It's come about, but it's not what market expected. Any view out there?
Yeah, no, I mean, it's been highly anticipated kind of demerger, and I think the market now is thinking, well, we don't really like this for many different reasons. At the end of the day, it's not a bad, it's a good move, and I think you have to look at it longer term as well in terms of how it will help cash flows going forward and ROEs. But in terms of the excitement, I think is probably over. And I'm not going to the length of saying you need to have a discount for Holdco and that, because it's too small a business in terms of the overall ITC revenues and profits. But it's at least a step in the right direction. But I think the market got over keen in terms of some of the valuations and some of the thinking that was around this demerger. But as you rightly said before, we'll hear more news today. So maybe there's positive surprises, but I'm not sure I would hold myself for that.
Andrew, a lot of the not ex-bank PSU stocks, non-bank PSU names which have been rallying, right? In the railway space, in the defense space. What do you make of it? It's an election year, the next one. And stocks are already up in most cases, at least 100%, if not more, this year or from last year. Do you own any of them, and do you have a broad view?
On defense stocks?
The non-bank PSU names. It could be defense, could be railways, and many other sectors. I mean, actually, as the rally is broadened, more and more of these names are starting to participate. Yeah,
no, so, Prashant, we've always talked to you about the themes that we like, and defense is one of them, renewable energy is another, CapEx cycle, electronics in terms of the whole industry. So these are the themes which will continue to play out in terms of getting better performance than say Nifty. And the one that we added recently, a few months back, if you remember, was beverages in terms of non-alcoholic as well as alcoholic and the premiumization. And I think you saw that with United Spirits results recently, that everyone's moving up the value chain, and that we're only at the start of this runway for the whole of the industry, both for non-alcoholic and alcoholic. So it's going to be a very, very strong earnings story over the next 4 to 5 years, in line with the electronics industry. So those are the two which I would focus in on at the moment.
The tricky part now is that, of course, we're heading into a global situation where it could be the end of the rate hiking cycle, right? We don't know for sure, but perhaps this could be the last rate hike in a while, and that's what the street has been penciling in, both global and local. Do you think that's over-optimism on the part of the equity markets, and how do you approach this global event now?
So, we've always had the view, Sonia, that the Fed were taking the rate hikes have been too severe, and this last one will probably be the step beyond. So we still feel that inflation's coming down. It's going to come down a lot quicker than people are expecting now, and that could still tip the US into recession. I know the Goldilocks scenario is it's a soft landing, and everyone comes out of it with no problems. I'm not of that view. So I still think there's a few hiccups along the way. But as I said before, we're very constructive on our markets. There could be some pullbacks because of global events. But otherwise, this whole prospect of money moving towards emerging markets, which it has done, towards the exporting countries first, and then it'll be India. We're seeing some of those flows already as investors chase growth as we come to the end of the rate high cycle and look forward to interest rates coming down sharply next year.
Andrew, I just want to ask you about the banking names, but for the time being, just requesting my director to pull up the Nifty and pull up the India VIX. Suddenly that's down close to around 10%, 9 to around 10%. Also, normally, cooling off of the VIX is a bit of a bullish sign, but it's cooled off in a big manner. So I'm not sure what's going on there, but just pull up the VIX. It's down 8 to 9%, approximately 9% now as we speak. It's heading towards the lower end of the range. We did see a bit of a bounce in the last few days because of the volatility that picked up. But for the time being, that's something that should be on our radar. We'll keep an eye out on that. Well, Andrew, what's the view on the banking names? Because we're searching for leadership. It appears in the near term, ITC has some bit of issues. Reliance has already, run up quite a bit. So your view on the banking names and the few results that we've already got, what would be in your pecking order?
No, I think the banking results so far has been in line with the market expectations. There's been obviously, I think there's concerns around deposits and NIMs going forward in terms of the kind of challenge in terms of gaining deposits and the price you have to pay for them. So I think that's one of the concerns the market has. Obviously, there's a change in leadership at Kotak at some point, and that will keep the market kind of concerned on how that's going to be, how that's going to go about going forward. So I don't think the pecking order's really changed. I think all eyes are now on HDFC Bank and how they're going to get this merger going, and again how they're going to get the deposit growth given the kind of expectations for loan growth going forward. So all of these factors, I think the market's kind of trying to kind of grapple with. And it's becoming a little bit more of a concern rather than it's a kind of a tailwind at the moment. But I think the banks will get through this very quickly because I think what we're seeing in the economy and the multiplier effect of the government spending and private capex, I think will propel GDP a lot quicker and earnings in the second half of the year, and that again will lead to more lending for the banks. So I remain positive on the private banks. Pecking order is really doesn't change that quickly. But I think the results have shown who's leading at the moment.
Okay, all right, Andrew. Thanks so much for stopping by and filling us with your view on the markets, a lot of sectors as well as stocks that we discussed. Wishing you a good day ahead. Well, we have talked about banks, so let's focus on one bank, Canara Bank. They posted a very good set of numbers in the first quarter. The numbers came better than what the street was working with. Now, their NIMs have come in the highest that we've seen in nearly 31 quarters. Gross NPAs as well, lowest in more than 30 quarters. Corporate loan growth, that's strong, but slippages remain a little bit elevated. To understand what's gone on in the past quarter and what's the way ahead, we're joined by Mr. Satyanarayan Raju, the MD and CEO of the bank. Hi, sir. Good morning. Thanks so much for joining in, and congratulations on a solid showing in the first quarter. My question to you is, what is the loan growth outlook from here on? It seems that it's more focused on the corporate book side because that's outpacing the retail growth side. So the growth from here on, and also on NIMs, it's looking very, very good. CASA has come down, cost of deposits have gone up as well. So how do both those two numbers shape up?
Good morning to you, sir. First, let me focus on the credit growth. The credit growth, we are given the guidance that current year credit growth will be 10.5 minimum. As we given the guidance for the first quarter itself, we could manage that the credit growth is around more than the 13% year on year. Even if you look at the quarter on quarter, it's a more than 3% growth is there in that. The second one, what the composition of the corporate as well as the RAM. Last quarter, we could maintain that the percentage is the 55% is RAM and the 45% is the corporate. Even the current quarter, the growth is in line with the same what we have given the guidance of maintaining the 55% and 45%. Look at that the quarter on quarter growth, RAM itself is more than 3%, sir. The corporate growth is 2.7%. That means that actually our focus on RAM is continuing because to take in higher yields, we want to take that because there is due to the interest expenses, high interest regime, there is a stress on the NIMs margins. To compensate that, our focus on the RAM is continuing. The CASA is as a whole, it's a little stagnated or little negative. But the bifurcation what I wish to share with you is there is a growth in the savings bank account from quarter on quarter. That's the reason behind that is that we have taken a lot of initiatives on the first working day of the current quarter itself. We have launched several new products targeting the younger generation, especially the salaried class. Our existing salaried class customer base is 11 lakhs. Because of this product, new product what we launched on the April 3rd, our new onboarding and from the salaried class.
Right, Mr. Raju. Right, sir. Right, sir. You've given us a fair bit of an overview about how the book is shaping up, and we thank you for that. But, your growth, credit growth is outstripping the deposit growth. So what does that mean in terms of NIMs? Because from a stock market perspective, we'll want to understand what kind of a range we should be working with. Please go ahead, sir. Go ahead.
Sir, our CD ratio was only the 73%. We are given in the starting of this financial year, the guidance is we wish to go for the beyond the 75%. In the first quarter, we could show that there is a more than 74% of CD ratio. When you have a scope to go up to 78% and you have enough liquidity in your system, so naturally our focus will be more on the credit growth compared to that liability growth. The reason behind that is that actually the liabilities we are given in the initial stages itself is 8.5% of the growth in the liability. We are in line with that, and we are sure that we maintain that because ultimately we have to manage effectively the margins on that, and that has given the comfort to us to that under this present high interest rate regime also we could able to maintain our NIM at 3.05.
Okay. So I wanted to talk a little bit about the asset quality as well. The slippages amount has gone up substantially this time, almost 3,500 crores. This compares to less than 3,000 crores last quarter. What was the reason for that? And if you can just tell us what is the guidance? I'm just trying to understand, going forward for FY24, what is the guidance on both gross NPAs and slippages? I don't think we can hear him very well.
I think he couldn't hear you, Sonia. I think he was answering the previous question. We'll just have Mr. Raju back with us from Canada in just a bit as soon as we are told. I mean, just to take a quick look at the market in the meanwhile, we're up 28 or 30 points or so, and market breadth is about 3:1 in favor of advances. I think he's back with us. Sonia.
Okay. Mr. Raju, is my voice reaching you?
Yes, madam.
Okay, okay. I wanted to ask you about slippages because the slippages have gone up quite a bit this time compared to last quarter. What's the outlook on that? Is the asset quality expected to worsen before it gets better?
No, madam. Actually, we have to compare the slippages always based on the circumstances of the first quarter of the previous year and the current first quarter of the current year. We should not compare that the quarter on quarter March, because the first quarter generally in the industry, because of that 1/3 staff will be transferred and by settlement and all those things, it's one or 2 months it will be settled down there. The another one is in the first quarter, the agriculture will pay a higher, show a little slippages because of renewals. The sowing season will start only in the June. These two things, otherwise I don't see any concern on the slippages. It's a marginally high in the first quarter compared to that the last March quarter. But when you compare to the first quarter of the last year, the 3,949 to it has come down to 3,428. Whatever the guidance we are given that our slippage will be around 1.3, we are confident that we can manage that 1.3 below than that current financial year.
Okay, so 1.3% slippages for the full year, FY24. What about your estimation of credit costs for the year, sir? Where would that be?
Given actually the credit cost guidance is 1.20, sir. Already we achieved at 1.10. We are expecting that the guidance is a minimum 1.2. We are expecting that around 1.1%. That's not what we are expecting, because we are focused on strengthening our PCR, sir. Compared to that legal the other things, we have given a guidance that we want to or improve the PCR to beyond the 90%. So for that we have to provide additionally to make my balance sheet a future stronger.
Okay. Mr. Raju, just to pick on the earlier point that we were discussing, this new schemes to attract more deposits that you said you've launched immediately at the sort of beginning of the first quarter. Could you tell us, I mean, what is your expectation? How much could this lead to by way of deposit gathering? And also, do you expect a big scramble for deposits? I mean, is it getting harder? Could you give us an overall picture?
Yes, sir. The first, let me speak on the products what we have launched is, one is the premium payroll, one is SB Select, one is current account. These initiatives, and we also has provided API banking launching to the corporates to deal with us, to divert their ancillary business to us. This has given in the first quarter, first 4 months, we got a 3,300 crores in the CASA itself, the accumulated CASA. We are expecting that our entire machinery is focused on that. And from July 1st onwards, we introduced a relationship manager concept to addressing the savings bank customers in the 5,000 branches. I'm sure that with these initiatives, our CASA will be taken a main focus in our approach, and that will take care of our requirement. Regarding the interest expenses and all, this quarter also we see that the same tempo is continuing. We have not seen any softening of interest in the current quarter. We expect that this softening may start in the next quarter onwards once the liquidity in the system is improved.
Mr. Raju, let's talk about some fundraising plans. Do you have any fundraising plans? And what's the plan with the other listed entity? That's Canfin Homes. Are you looking for a buyer, or has that been shelved for now?
Sir, actually the capital, we are already maintaining a more than 16% compared to the peer banks. We are very strong on that. Our board has permitted us to go to the market to raise 7,500 Tier 1 and Tier 2 bonds. 81 bonds is 3,500 crores and Tier 2 bonds is 4,000 crores. And we already got the permission from the board. We will come to the market whenever we feel that the pricing is competitive for us. That is for capital rising. The second one is the Canfin Homes. The Canfin Homes is the Canfin Homes. You see that whatever we have given you, that's we are continuing with that. First, we want to focus on the strengthening of that Canfin Homes. We want to see that the value of the company is doubled in 3 years. That is our main focus immediately. So at this juncture, we are not looking at selling our stake. We want to continue with that Canfin Homes till we satisfy that the value, real value, as reflected in the market. So our working is focusing on the doubling the value of that company.
Okay, so you're looking to double the value of Canfin Homes. You're not looking to pare down any stake in Canfin Homes, at least in FY24. Got that? Any other subsidiaries or JVs where you're planning to bring down your stake?
Yes, madam. Actually, our another two major important subsidiaries are Canara HSBC Life Insurance Company and Canara Robeco Asset Management Company. These two are also our key subsidiaries. In that, we are holding a 51% stake in both the companies. We already has given an advice along with the other stakeholders. We have taken them into confidence and given a guidance to these two boards to initiate the process of going for the IPO. And they already, both the companies have started their work, but it needs around the 18 months time. We expect that these two companies may come to the initial public offer in the second half of the next financial year.
Okay, all right. That's important information. Thanks a lot for joining in. We've run out of time, not out of questions, but thanks a lot for speaking to CNBC-TV18. Well, that's the word coming in from Canara Bank. The market is very, very quiet. The mid-cap index is doing quite well, though. So on the other side of the break, Amit Dixit of ICICI Securities will join in to review the Q1 performance of Tata Steel and other earnings from the metal space. Later, we'll connect with the management of Thangam Jewellery to talk about their Q1 earnings as well. Stay tuned.
Welcome back. Well, the markets are just holding on into the green. The good news, though, is that the broader markets, you have way more number of stocks that are advancing in comparison to the number of stocks that are declining. Though the declining stocks from around 300 to 400, it's moved up to around 700 stocks that are declining. The crisscross lines will tell you the picture. They're coming a little bit closer to each other. But the big number that we got was Tata Steel, and the numbers look better than what the street was working with, while JSW Steel as well reported a solid set of numbers. Amit Dixit, the analyst at ICICI Securities, joins us to decode those numbers. Hi, Amit. Well, in a short while from now, we have a media interaction. You'll have a con call as well. But what did you make of Tata Steel's numbers? And what are the key points you're looking at for the management to clarify?
Yeah, hi. Good morning, Nigel. So, Tata Steel numbers, as you rightly said, they are ahead of street estimates. In fact, Tata Steel Europe was in line. And if I can say about domestic business, the realizations were higher than what most of the people would have penciled in, including us. I would say the greatest highlight of this result was the insurance buy-in of the pension liabilities at the UK operations. I think that is something what would give great comfort to the market in terms of the future strategy or the future steps that the company might take with respect to UK business. Otherwise, if you look at the other finer prints like, net debt that has gone up slightly, mainly because of the capex, both JSW Steel and Tata Steel have been incurring capex at their respective brownfield expansions. And therefore, it was not entirely surprising. Plus, do remember that first quarter is usually the time when working capital buildup happens. So nothing out of turn over there. So I believe that the results would have satisfied everyone on the street. I mean, there is nothing to be dissatisfied about.
All right, Amit, you're saying that that pension liability is solved now for the UK business, which is good news. What can they do but now? Should they be, selling the business? I don't know whether anyone takes it in the current form. If they shut it down, will you see that as a positive? Because now the pension liability is out of the way. The way ahead for the UK, though, is going to be very important because that continues to be a drag. So what would you like to hear on that front?
Yeah, so if you look at the recent times, the management has been taking steps to streamline, to de-risk the UK business to a very large extent. and this pension liabilities was a big element to it. Now it has been removed, and as we understand from the last con call, that the useful life of UK assets is 1.5 years, and management is engaging with the government in UK to ensure that there is a level playing field, or there is the operations actually get more sustainable. Now, any of these options would be taken very positive by the market. Plus, de-risking, actually what it does is that in case, in the event you want to take any affirmative steps, it will be far easier for the company to take it, although they have not announced it anywhere in the public domain. But it would be great if they can somehow, get either curtail the operation significantly, or somehow get their skin out of the game from there.
Okay. I wanted your thoughts also, Amit, on JSW Steel. The numbers looked very strong, but do you think that the valuations are a bit expensive at the moment? And what do investors do here?
No, so exactly that was our tagline of the report also, that numbers were quite robust. And these numbers were robust. If you look at the fine print between Tata Steel and JSW, very, very similar thing, that because of domestic realizations being higher, not domestic, actually the blended realizations being higher, partially because of export component, partially because of contractual prices, there was a beat. However, in case of JSW, although the company is on its growth path, and it is one of the very, very few companies in the world that actually can boast of adding steel capacity every year. However, with growth comes the leverage. And while the company is not incurring any incremental leverage, I don't think that the debt will go down as well. And that actually makes it more prone to the steel prices cyclicity. And this is something that we would be wary about. So that's why the valuations are rich, and therefore we have a hold rating on the stock at the moment.
Okay, all right, Amit, Tata Steel has been talking about reducing debt by $1 billion approximately. For this year, what are you factoring in your numbers? How much of debt can they reduce? It's gone up by 3,500 crores in Q1 because of the capex. But are you factoring in a $1 billion reduction, or less or more?
See, Nigel, that $1 billion reduction is not something cast in stone. The management's, I would say, the thought process is to reduce debt by $1 billion. In few years, where in some years where there would be heavy capex, this can be lower. While in the years where the capex is not there, it can be higher. Overall, if you look at the, let us say, 5-year scenario, the average debt reduction per year would be $1 billion. But having said that, in our numbers, we have factored in a little bit lower than 1 billion. We have factored in around 5,000 crores of debt reduction in FY24. Okay. But in FY25, we have factored in a little bit higher. The reason being that we expect that most of the capex of Kalinganagar Phase 2 would have already been done, and therefore there would be cash flows from there. And therefore, if you look at the overall picture, both FY24, FY25 combined, then the debt reduction is 2 billion. That still comes to 1 billion per annum.
Okay. I just have a slightly macro-ish kind of question, because it's metals and commodities. Yesterday we had the Chinese Politburo, the second of the three which are held in a year. And generally the commentary out of there seems to be that there is no, it's an acknowledgement that growth is slowing sharply in that country, but there is nothing in terms of big stimulus or anything, no indication of it. Is that necessary, Amit, for a tailwind for the sector, or you think it doesn't matter?
No, it does matter. In fact, anything to do with stimulus is a positive thing. But what we have seen often, of late, that the Chinese stimulus has had diminishing utility. So they have been trying to stimulate the economy, but it has not happened so far. In fact, we, in our numbers or in our outlook, we have not even factored in stimulus. If it comes, it's a positive thing. What we have factored in, though, is the production curtailment. So the flat control policy, for instance, in China, the fact that there are certain blast furnace operations in Tangshan that have been asked to curtail their operations. I think these are positive. So if production is lower, export is lower. And, from China, only two things matter: what comes out of China and at what price. So price-wise, we are comfortable now. We have seen prices coming up. So from $525 per ton 1 month back, prices are now back to 570 range. If exports also reduce, so that would be a tailwind. We are not factoring in, to be honest, any stimulus measures.
Okay, just one final question then. The problem with Vedanta, as we all know, is the debt situation, right? And that has sort of made investors averse for a long time. Do you think that will be an overhang for the stock even in this year, or can things change?
It's a difficult question, to be honest. This has always been an overhang, high debt, and the fact that zinc prices have not been doing well, and zinc still accounts for close to 50 to 55% of overall earnings. So clearly, that has got a headwind on the earnings, and therefore the debt situation would remain precarious. And however, to offset it, there is always a dividend, a phenomenal dividend yield for investors. But I think overall, what people are looking at is the maturities at Vedanta Resources. So as and when they happen, as and when the dates come closer, there would be a little bit of ripples in the market as far as the stock is concerned. But overall, I think they should sail through because the business fundamentals are okay. However, there could be intermittent, I would say, wavering in earnings, particularly LME zinc prices not doing great is something that remains a concern at this point in time.
Are you covering the stock as of now, Amit, or it's not under your co-coverage?
Well, it's we are covering it, but it's under restricted list, so I can't really speak about the outlook and the estimates that we have.
Got it. Thanks very much, Amit. Appreciate your time here on CNBC-TV18. That's a conversation around Tata Steel and other steel companies, primarily, of course, a little bit Vedanta as well. Well, we move on to our next company, Thangam Jewellery, which is a Tamil Nadu-based jewellery company, reported a blockbuster set of earnings. Their numbers came through during market hours yesterday. The stock shot up. I think it was up almost about, it was up 20% at one point, cooled off a little bit. Now, gold jewellery sales for the company are up 27% in the first quarter. 2 days of Akshaya Tritiya sales accounted for 109 odd crores, and that is a 37% surge. The stock's done very well, 100% in the last 3 months or so. Mr. S.M. Lakshmanan is Vice President, Finance and Accounts at the company, and he's joining us now to take some questions. Sir, good morning. Good to have you with us here. Prashant this side. What has changed, sir, in the company? Because last 2 quarters, you've kind of moved into a different margin zone. 8 to 10% as compared to the 4% that you used to clock for many quarters prior to that. Could you start there? Has there been any change in the accounting policy? Go on, sir.
Good morning. Thank you for the opportunity. As you said, financial year 23-24 has started on a strong note. Q1 financial year 23-24 sales is 959 crore rupees. All the products volume growth has been shown in the first quarter, year on year, as well as sequentially. Yes, as far as the margin aspect is concerned, non-gold composition, non-gold product composition, the company focuses on very vigorously. Diamond has been doing wonders in the company, and being the high margin product. And in every quarter, the company has been having a diamond day, which tries to amass the diamond sales, and this is being done for the 3rd or 4th quarter. And every quarter, the diamond date has been trying to show good improvements. And yes, the company, the non-gold composition for this Q1 is at 9.5%, as compared to the past numbers of 8.5 or 8 or 9.5, and the company is on its path towards a 10% non-gold composition in the short term, and eventually in the midterm, we are looking at 12% non-gold composition. This is one of the primary changes that have been taking place in the company in the recent past, and definitely youth appeal goes along.
Sure. Mr. Lakshmanan, so you're saying that... So you're saying that the non-gold component is going to go higher. You're looking at about 12% in the medium term. Got that. If you can tell us, what does medium term mean? I mean, are you looking at getting it to 12% by, say, FY25 or in FY24 itself? And if this is the case, then does that mean these 10% margins that you clocked in this quarter is something that you can better? Can you sustain it?
Yes, this 10% non-gold composition I'm talking about, let's take FY24, March 31st, 2024, and 12% probably by FY25 or FY26. And yes, there is every possibility that the company will be able to sustain the margin because of these reasons. And even in the gold, which tries to have 90% of the sales, yes, the high margin product mix has been taking place in the gold as well.
Got that. So, just to understand, is there a kind of earning sensitivity thumb rule that we can apply to you in terms of if gold, because gold will still be, even in 25, will be the predominant sort of chunk of the business. If gold prices move up, this is how much earnings will move up by, or if gold prices fall, this much, how much, this is how much, this is what the impact on P&L is. Is there a thumb rule, earning sensitivity?
No, we have very clearly mentioned in the results that operating profit has been doing very good, apart from the pricing or inventory profit, which has been shown very clearly in the results to the extent of 32 crore rupees for the first quarter. Talking about the operating profit itself, yes, the company's efficiency levels have been improving in a focused manner quarter after quarter, year after year. For example, let's take the expenses. Yes, so the company is having the expenses in a consciously controlled manner, be it the salary cost, or be it the media cost, or be it the rent or other administrative expenses, promotional expenses. The company has been incurring only to the effectively, relevantly required extent.
Okay. So can you tell us what the game plan is for the business as far as expansion goes, right? So far, you've been a Tamil Nadu player. Are you planning to diversify or move beyond Tamil Nadu? And what would the store openings look like? What is the targeted store openings in FY24?
Yeah, we started the financial year 23-24 with 53 showrooms. One showroom had been opened in Q1, which is Kumbakonam Delta Belt. With the impressive performance having been seen in the Trichy showroom, we are going ahead with the Delta region, and the first one is Kumbakonam. Okay, as far as the remaining months or quarters of the year are concerned, let me talk about in 5 sub-elements. First one is the company is looking at 4 to 5 new showrooms to be opened in Tamil Nadu, in the state of Tamil Nadu.
How many?
Okay, we are looking at the firming of the location, etc. Probably.
Sorry, Mr. Lakshmanan, how many, sir? You said how many?
4 to 5.
4 to 5. Okay.
4 to 5 new showrooms. Okay. The second point is the company is setting its foot in Chennai in the first quarter of FY24-25, which I mentioned in the last session as well with the CNBC. Okay. For which the preparatory work have been going on during this financial year. The third one is that the company is on its relaunch path as well. As far as the current year is concerned, nearly 6 branches are getting relaunched. Fourth point is that the company has got a small format showrooms called TMJL Plus, primarily for silver articles, silver goods, as well as the customer advance collection sectors. 4 of these showrooms are getting upgraded during this financial year. The fifth sub-element of expansion is the company is going ahead with the boutique shops, one for silver and one for the diamond in the Madurai town during this financial year. So the company is calculatively aggressive as far as the expansion is concerned, and setting its foot in Chennai in the first quarter of FY24-25, going to be accompanied by 3 or 4 more suburban showrooms in and around Chennai.
Okay, all right. We'll let you go on that note. Thanks a lot for joining in. The stock is on a tear, up 6.5% right now. So the street definitely likes what you're saying. Let's get back to the markets then and focus on the big movers here. The headline index is very, very quiet, but it's the mid-cap end which is looking pretty good. So Mitesh Thakkar is joining in to give us more on that. Mitesh, at 10 a.m., what are the trades?
So the market has been very flat and very subdued post the opening. But on the stock side, I think the railway stocks could again pick up momentum after a cool off yesterday. So I'll suggest a buy on IRFC. Keep the stabilizer levels of 33.90 and a target of around 36.5 can be looked at on the upside. While on Britannia, I have a negative call. So that's a sell. Keep a stop at about 49.85, 49.85 and a target of around 48.50 can be.
Okay, well, we'll leave it there, Mitesh. Thanks very much for that. We'll take a quick commercial break here with news that the indices are absolutely flat on the so quiet. Look at Sharda Cropchem. Just want to leave you with that one. It's down 6% after yesterday's 6% cut. So that is sharply down. And the other one is SRF. We were talking about that in the morning as well. That is recovered. I mean, it's still down 1 1/3%, but it's a sharp recovery on SRF. The low was 2,040. And that is recovered about 75 rupees from the day's low, which was pretty much, I think, right at the open. Manisha will be joining us with a commodity check and more stocks which are moving around after that. Stay with us.
Andre.
Welcome back. Let's get a quick handle on what's happening in the world of commodities. Manisha Gupta is joining in. Manisha, what's the one commodity you're tracking today?
Well, I'm looking at energy as a sector because, the inflation concerns are really back. It's not just the food as a sector which seems to be surging in sense of prices, but the energy prices have been on the higher side as well. Starting with the crude oil prices, and we are trading at around 3-week highs onto this one. The prices did gain 2% overnight, and we have seen 4 weeks of gains already into the market. $83 a barrel of a high is what we saw in the New York session yesterday, and we're trading around those levels even at this point in time. Two major factors, one is the tight global supply, and the second is the firm Chinese demand is what is keeping the prices at a 3-month highs. Starting with the global supply first, and remember, Russia and OPEC and allies have deepened their output cuts for the month of July, and they're following it furthermore for the month of August as well. And the markets do believe that in this quarter and the next as well, you could be looking at tightness coming in. And if the demand comes in from China, that could further support prices. There is geopolitical premium also building up as fighting in Russia and Ukraine escalates, and that premium is into the prices also. China, in the meanwhile, is looking to increase further in liquidity injections into the private projects there. Citi, that has led to Citi coming out with a report suggesting that for this quarter, the third quarter of calendar year, $83 a barrel is what they're estimating as an average price for the Brent markets there. And then it is also going to be about the US inventories, which may show a decline. That data comes in today and tomorrow. And what also comes in today and tomorrow is the US Fed meeting. The 2-day meeting kickstarts today, and we will hear the guidance and the outcome today, tomorrow evening. While the 25 basis point of a rate hike has been factored in, it's really going to be about the guidance going forward that the street will be watching out for. And then you have the European Central Bank meeting that comes in on Thursday. So the next 3 days is going to be quite eventful. Not just crude, if you look at the natural gas prices, we have seen them trading at near 1-year highs. There's increase in demand, there is decline in inventories, and those are supportive factors there. Take a look at what the prices have done on a weekly and a monthly basis then. And this is a sector that seems to be really surging for the month of July here. So for the week, we are up anywhere between 2 to 8%. As you can see, whether it's Brent, gasoline, heating oil, Urals oil is Russian oil, which has seen 6% of gain on a week basis and 17% up for the month of July as well. And that's exactly what the month of July has brought in for you. 6 to 20% of gains is what we've seen coming in for the energy markets for this month.
All right, Manisha, thanks very much for that. So that's basically the commodities picture. Let's move on and talk about a few specific stocks which are moving around. SJVN, big volumes and big gains as well. The run has been non-stop. Vivek is here. He's going to focus on SJVN for us. Vivek.
Well, good morning. We highlighted this, earlier today as well. So the slew of order wins that the company is getting as far as this renewable energy is concerned is something is actually aiding the rally as far as the stock is concerned. So today, the company has declared that the Andhra Pradesh government has allotted 5 projects worth over, 5 gigawatts for the company. And all of these projects are located in the Dibang Basin as far as Arunachal Pradesh is concerned. The company says that this particular projects will entail an investment of over 50,000 crore. Now, this is in continuation to the other order that the company received on July 22nd, where the company received a letter of intent from the Punjab Power Corporation for 1,200 megawatt solar power projects, and these projects would be developed again on a build, own and operate basis. Project cost for that is over 7,000 crore. Now, the company has a stated target that it has given as far as the analyst community is concerned of 5,000 megawatts by 2023-2024 at the end of 24, that is, and 25,000 megawatts by 2030, out of which over 50% of the target has to come from renewable sources. So the slew of order wins is actually aiding the company meet its stated 2030 renewable energy targets, and that is what is aiding the rally as far as SJVN is concerned.
Okay, and remember, we had highlighted this stock in top 10, and Vivek had highlighted that it could be in the green. It is the big mover this morning, up 6.5%. But Chennai Petroleum, DCM Shriram, Sharda Cropchem was all on Sonal's radar, and she had spoken about how these stocks could be under pressure in top 10, and look where it's at, down almost 8-10%. Over to you, Sonal.
Thank you so much for that. Well, 2 of them reacting to earnings and 1 on weak commentary. Let me start with Chennai Petro. Lower cracks is what impacted the earnings this time. Revenue down 18%, margins lower by 300 basis points, and profit declined around 45%. And GRMs were also lower on a quarter-on-quarter basis. The stock is lower in trade, and so is MRPL on the back of weak numbers from Chennai Petro. DCM Shriram, another weak set where revenues declined 2%, EBITDA was down 60%, profits were down 78%, and it's their chemicals business which did not do well. That's where the EBIT was down 90%. Vinal segment saw a loss of 3 crores versus an EBITDA of 70 crores. Now, Sharda Sharda Cropchem reported numbers yesterday, but their commentary did not look so good. They reported a loss this time versus a profit. They said revenues degrew due to lower sales in Europe and NAFTA region. They saw lower pricing, especially in the US markets, and there is high inflation, recession and adverse weather conditions as well. Raw material and finished goods sales price have reduced substantially. However, the company is seeing an improving trend in Q2, but across chemical names, we are seeing some weakness in Q1.
All right, Sonal, thanks very much for that. We're up 12 or 13 points, so it's neither here nor there. The indices are trading kind of flat. Now, Surabhi is focusing on JK Paper. She told us in top 10 that the stock will be higher today. It is. Surabhi, take it away.
Thanks so much for that. So JK Paper reported a good set of numbers. The revenues were up 11%. There was some pressure on the gross margin front due to higher pulp costs, but they've still managed to maintain their EBITDA margins at 30%. The EBITDA was up 13%, and that was aided by lower power and fuel costs. The PAT was down 18% on a year-on-year basis, and that was because the finance costs were higher. The management said that the results have improved due to the acquisition of the corrugation business that they had made last year, and also Shirpur paper mills have increased volumes and better realizations, which has also aided the revenue growth this quarter.
Okay, thanks a lot for that. So lots of stocks. Cement stocks, by the way, are surging right now, so don't lose sight of that. ACC is the big gainer, but let's take a quick break. On the other side of the break, our special segment, it's the economy. Lata will get chatting with Manish Agarwal of Phillip Capital to talk about Q1 earnings in the banking space. Stay tuned.
We are halfway through the results season and halfway through the banking season results as well. The big three, HDFC Bank, ICICI Bank and Kotak Bank, have announced their numbers. Three more biggies, Axis Bank, SBI, and maybe you can put Bank of Baroda in that list, are yet to report. Axis this week itself. Among the mid-cap ones, again, we have IndusInd, Federal, Bandhan, all of them. But a bunch of other mid-cap, PSU and private, are yet to announce. So mid-season review of the results season is what we have for you, with an expert, Manish Agarwala, the co-head research and the banking expert at Phillip Capital. Manish, good morning and thank you very much for sparing time for us. Let me start with, HDFC Bank, though I have your very positive report on ICICI Bank. But let me start with HDFC Bank. You point out in your comparison that the deposit growth has been underwhelming for HDFC Bank, as have been margins and ROA compared to ICICI. So do you bring down your estimates of HDFC Bank? Are you still a strong buyer in this stock?
Yeah, good morning. Thank you for having me on the show. See, HDFC Bank, we all know they will have a challenge in terms of deposit growth because of the merger-related headwinds. However, we don't bring down our earnings for HDFC Bank. What we believe is that going ahead, since there is a moderation in the growth from a medium-term perspective, I think multiple will stay where it is right now. We don't see a room for multiple expansion for HDFC Bank. However, the favorites of the market has been ICICI Bank. This quarter, we have seen a very strong demonstration of deposit accretion, despite the fact that HDFC Bank is very aggressive in the market. So I think ICICI Bank will remain a preferred pick by the investor in the medium term at least. Okay.
Well, I just wanted to say one point on behalf of HDFC Bank, if you please. Even in the table that you give us, although the quarter-on-quarter increase for HDFC Bank is, 1.9% in deposits. If you look at a year-on-year comparison, they are over 19% for ICICI Bank's 17%. And this is happening on a fairly large base. They appear to have slowed only in the fourth quarter. I don't know if that's by design, because third quarter, their deposits were like screamingly high. So would that mean that HDFC Bank can deliver what the MD promised, doubling the bank in 4 years?
Yeah, we don't doubt the management guidance. However, our sense is that there is a requirement for the deposit to replenish the borrowings of Limited. There is a requirement for deposit to take care of PSLC requirement, for investment for SLR and CRR. So my sense is that probably the growth might be slightly moderate in line with the industry average, or maybe a percentage over industry average, which is unlike of what SDFC used to deliver in the past. So because of this moderations, probably market might not be very comfortable giving a re-rating multiple from here on.
Fair enough. But, okay, just to persist a little more, now in the housing sector itself, which is again secured and your credit costs tend to be lower, provisioning tends to be lower, there they may have an edge over everyone else because they already have an excellent marketing team and very, very cheap cost of money compared to the erstwhile HDFC. You think that they can turn the tables on that front?
See, mortgage market has always been very competitive. I understand that HDFC Bank will have a better cross-sell opportunity here. But the thing is that the market, all other banks are quite competitive. There are DSS playing in the market. At the same time, we should not forget the fact that HDFC Limited's mortgage franchise was also built on the relationship with the developers. Now, we have to be very cognizant of the fact that how this relationship go ahead with HDFC Bank. So that will be a very key deciding factor, how they pull up this mortgage business or housing business for themselves.
Okay.
All
right. So it's a wait and watch until then. I take your point to whether they are able to cross-sell as effectively. What the management told us during the various press conferences is that HDFC used to lend only in very, very urban centers, and now they have deeper penetration possibilities with the bank. But the other, one more point on the HDFC, ICICI, Kotak comparison. This is something that came from Financial Express today, and we have not personally verified it. The story says that the managing director, Jagdishan, met Apple very recently, and when Apple Pay comes to India, they're going to tie up with HDFC Bank. Will that give them an edge on credit cards and therefore that kind of products?
See, we can never undermine the capabilities of peers at the same time. Yes, HDFC Bank will have a very competitive partner there, but we cannot undermine the edge or say capabilities of the peer bank. I think everybody is working on their strategy. Secondly, credit card market is getting more and more competitive. Our sense is that the ratios or return ratios in this business can only come down from here on because there are pressures on say reward points, there are pressures on NDRs. So our sense is that top three players will remain very, very competitive in this business. Yes, the other lot might see some higher pressure compared to the larger banks.
Okay. So right now, if you have a buy list, what are they in terms of the top results declared already?
Yeah, so we remain very positive on ICICI Bank, followed by IndusInd and Axis Bank. We like SDFC Bank, but we see that SDFC Bank return from here on would be in line with their ROE. So probably that's also decent enough kind of a return. But in terms of preferred pick, this three would be my preferred pick.
Okay, your 1140 I saw was the target price for ICICI Bank. We are running that line. What would the target price be for Kotak and HDFC Bank?
So for Kotak, our target price is 2,200. And for HDFC Bank, we have a target price of 1950. So this target price, probably, we revisit all these numbers as we progress in the subsequent quarters.
Okay. Well, I'll, time permitting, come back to Kotak Bank since there will be a change of management shortly over there. But let me just quickly speak about Axis and SBI. I'm more interested in SBI. Would that rank among your top buys now? There are some analyst reports I read which are seeing a blowout quarter for SBI this year. Your thoughts?
Yeah, you are right, Tata. See, PSU Bank, might outperform in terms of credit growth this year. If you look at the credit growth number for the industry, we were positively surprised, despite the Q1 being a very moderate quarter or modest quarter. And if you look at the results published so far, our sense is that the SBI can outpace significantly from what they have been guiding in terms of credit growth. Second to that is the margin. Bank sitting on excess liquidity. Probably SBI along with other public sector bank will be in a much better position to withstand the margin this year. So we remain upbeat on SBI from here on.
Okay. What kind of a margin are you expecting?
So our sense is that probably SBI should maintain their margin in FY24, what they reported in FY23, which is again a good performance compared to what.
Yeah, one of their best performances. That's right. Within the PSU banks, would you go in? Would you maintain a buy on any other? Is BOB one of your buy list? I thought.
We play this space through SBI.
All right. Okay, so not coming down to BOB, though it has got into the buy list of some brokerages. Okay, Manish, a more general question. There are some banks which are beginning to show that the best of asset quality improvement is behind the system. If you looked at, say, Federal Bank, which else? Just now, I think, was it Canara Bank? And even Bandhan, the AU Finance. I'm just taking across the spectrum. People have shown a slight increase in slippages. It looks like the best of credit cost is behind the banking sector, you would say?
Yeah, so credit cost, if you look at, they are below the historic mean.
Yes.
So further improvement from here on looks difficult. I agree to that point. But what is more important is the sustainability of the credit cost at the current level for at least for next few years. That's what the call we have. So we are not much worried about this quarter's slippages movement by some of the bank because we give a benefit of doubt of Q1, this being a quarter where there are some agri-related slippages which come at the same time the recovery and upgrades takes a backseat at this point in time. So we are not much worried. Yes, we are watching some of the unsecured space, specifically in the low ticket bucket, very carefully. But most of the banks are not very prevalent in that space. So we are quite comfortable with the credit cost, at least for next couple of years.
Okay. Anything specific on Axis Bank that we should watch out for?
I think asset quality probably. I think the flow from restructured will be complete in this year. We will be more worried if the flow comes from the book which were built in previous couple of 2-3 years. So that is the area where we will be very watchful. Otherwise, I think the corporate cycles are very favorable. India still, deleveraging on retail side, bearing few pockets and few asset class. I think we are quite comfortable at this point in time.
Okay. Just a word on Kotak Bank. Would you change your view now that Uday Kotak will no longer be actually at the helm, even if he's a non-executive, non-independent board member?
See, Kotak has built a very strong franchise driven by process. Yes, the top management matters the most in banks, but we won't be much negatively moved by this change. However, in case of Kotak, the arguments are slightly different from our point of view. We see some pressure on the margins for them. This at the same time there is a cost buildup in terms of OPEX. And finally, Kotak has accelerated the pace of unsecured business. Now, probably the credit cost will not remain where it is. Even the management has increased the guidance for credit cost. So there are few changes because of the balance sheet mix change. They should continue to report on the highest ROA in the system. So our call is that probably the growth and the philosophy should continue what Kotak has started, Mr. Uday has started. But again, the point here is that in the sector, since the slate is clean, there are growth opportunities. I think investors are picking the stocks where there is a value, there is a growth. So that will be the winning names even going in.
Okay, I'm being warned I'm out of time, though I'm not out of questions. Just tell us your entire buy list in the banking space. You told us Axis, ICICI and IndusInd. Any other?
So in a small space, we continue to like Federal Bank, we like Equitas. These are the names which we like. Even for the AU Small Finance Bank, I think this year is a tough for them because of margin pressures. But some of these names are a play on the interest cycle reversal. So we will accumulate some of these names over the year.
All right. We will invite you later for a more detailed analysis after the entire results season. Thank you very much, Manish Agarwala, for preparing us for the results henceforth and for giving us a view on the results so far. The markets haven't gone anywhere in the meantime. Absolutely as flat can get, with the mid-caps a bit nose ahead. That's all. Quiet day. That will give time for more analysis, and that's what's coming up for you on Chartbusters after a short break.